And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Tuesday edition of The Real Investment Show. I'm your host, Lance Roberts, of course. Get by the website, realinvestmentadvice.com. Our latest outlook and something we'll talk about today is on the website, talking about, well, no recession now, but recession likely in 2023. We'll talk about that this morning along with quite a few other stories. Walmart out this morning announcing earnings, beating estimates, $1.77 versus $1.62. Sticking with their second half outlook from what they reported in the first quarter. So remember, Walmart had come out in the first quarter, guided down, pretty sharply for the second quarter of the year in terms of retail sales, slower foot traffic, inventory builds. Of course, talking about laying off employees, hiring freezes, etc. So sticking with that second half outlook, stock is trading up this morning though because they did beat estimates. So again, the stock had already taken a pretty good hit earlier this year. So again, just kind of recovering some of that. And of course, that's also been kind of in line with this recovery of the market that we've seen here over the last few weeks. Again, everybody's getting very bullish now. Lots of good bullish articles coming out. The number of stocks trading now above their 50-day moving average has reached 90% of the S&P 500 components. So historically, that suggests higher highs, right? And so it's interesting when you think about this, just a few weeks ago, everybody was super bearish in the markets and there was literally no reason to be invested. We were getting phone calls like, get me out of the markets. And, now, markets have been performing very well. And now everybody can't wait to get into the market. So it's always interesting to see how fast psychology changes in the markets because, this is what leads us to make bad investment decisions over time. Either we sell out of the markets or we try to get into the market all the way. Markets are very overbought here short term. We're currently trading well above the 50-day moving average. We have a nearly 9% deviation above the 50-day moving average. Now, all that means is that, as we've talked about before, we've kind of just stretched the rubber band, so to speak, as far as we can in one direction. You're going to get a pullback here at some point. So again, if you've kind of missed this rally and you're looking to get into the markets and have more equity exposure, that's fine. Certainly some bullish technical reasons to do that. But look for a pullback here, probably somewhere right around 4,000 on the S&P. Certainly wouldn't be out of the question. We're currently about 4,280 on the S&P. So a pullback a bit here of 2-3%, not surprising. Give you a good opportunity to add some exposure, work off some of these more overbought conditions that we've been talking about now for the last few days. And again, markets just kind of ebb from one side of the flow to the other, and we went from extremely bearish and now we're getting back to extremely bullish, and that's not surprising. Again, a couple of things here, though, is always interesting, is that the markets are rallying on the expectations we've said before that the Fed is about to pivot, that September will be the last rate hike, and soon we'll be back to cutting rates and doing QE. But if that's the case, that's not really bullish, because if the Fed is having to come back and cut rates and do QE, that means that markets aren't doing well, right? They're trying to bail out financial instability. So while we're rallying into this thesis that the Fed is almost done hiking rates, the consequence of them not hiking rates historically has been a recession. And this is why we were talking about a minute ago that when you read today's article that's on the website talking about no recession now, of course, everybody's looking to the first 2 quarters of this year going, oh, that was the recession. No, really probably wasn't, because there's other indicators that feed into that recession number other than just 2 negative quarters GDP growth. And if we start to see revisions to Q2 that take it positive, which is possible because of the employment data, then all of a sudden we don't have a recession. So where's the recession, right? And that's going to be the question. And again, when you take a look at what's going on with manufacturing and services and retail sales, et cetera, that all still kind of suggests that the recession part is coming. We're not quite there yet. The economy's definitely slowing down. There's no doubt about that. Manufacturing indexes are all pushing into contractionary territory. And importantly, as we saw yesterday, we've had lots of these regional Fed manufacturing surveys out as of late. which are clearly kind of that more real-time data about the economy, new orders are dropping quickly. In other words, people placing new orders on the manufacturing side are pulling back quickly, which suggests that demand, right, for goods or services are slowing down, and so people aren't ordering as much. And before, they were having to order a whole lot because they had no supply because of the economic shutdown. Now they've got too much inventory and they're not ordering more stuff. They're just trying to sell the stuff they have. Again, this goes back to Walmart and Target and others that have talked about these inventory overhangs that have occurred. They were front loading a lot of this inventory, expecting this liquidity driven demand from checks to households to continue. And that's now, with that money running out, that demand is now slowing fairly quickly. Of course, high inflation also impacts that as well. So again, as we kind of look at this, there's certainly a lot of challenges ahead of the markets on a fundamental basis, and that's the real challenge here for investors. Technically, again, a lot of good bullish things that are going on. The 50 days crossed above, the 20-day moving average has crossed above the 50-day moving average. It will probably cross above the 100-day moving average in the next day or so. The markets are challenging right now the 200-day moving average. A break above the 200-day certainly confirms, that the markets are certainly back into more bullish footing. But we're pushing right up on that 200-day moving average. Just a terrific rally that we've had here over the last couple of weeks has been great. Lots of speculation in the markets, of course. A lot of this rally's been short covering. Again, because of the sell-off we had earlier this year, we had all that negative sentiment. We had a lot of shorts in the markets, and so a big chunk of this rally over the last really kind of 2 weeks has been a tremendous amount of short covering. That's those short positions having to be bought in to cover them. That's helping fuel this advance as shorts have to cover their positions. Now, interestingly, and something worth considering, this rally has been on very low volume. If we take a look at on balance volume, right, which is just kind of the volume of buying and selling balanced out, there really hasn't been a lot of commitment to this rally. So it's been a low volume rally on that basis. And again, that kind of supports this idea. A lot of people talking about this being a bear market rally, and that's certainly still a potential here. And there's certainly some ingredients, again, short covering, light volume, etc., suggest this is, could be a bear market rally. We won't know until this works out. But again, on the other side, when we take a look at a lot of the technical data, right, the number of stocks above the 50-day moving average, the moving average crossovers, where supports are, those are being lifted here. Those technical indicators suggest that we're back into a more bullish mode. Again, this is a very challenging market, why I suggest that we just be careful here. And as we talk a little bit more this morning about some of the data that points to an economic recession next year and what that might do to stocks, we also have to remember that we're still combating very high rates of inflation. The Fed is hiking rates, and there's certainly reasons that we want to be cautionary, right now, particularly with our investment capital. Again, this has been a very nice rally. And again, a lot of people were trapped in, if you didn't like this first part of the year and you didn't like being down, we talked about you're going to get a rally here. This is your rally to sell into and rebalance that risk in your portfolio. And again, this is where most people make mistakes. Now everybody's expecting this market rally just to take off and we're in a new bull market. That could be the case. But even if you rebalance risk here and reduce exposure a bit and get yourself kind of back to a balance you feel good with, that doesn't mean you can't come back and add equity exposure later when we get a pullback in the market, because we will get opportunities. We will get corrective periods that will allow you to add exposure. So again, you don't have to be all in all the time. Just kind of manage that risk as we kind of go along here. Okay, quick break. We'll come back. More of the Real Investment Show. Why no recession now, but in 2023? We'll talk about that and a whole lot more. Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Could your job still be at risk? A new normal can still include new obstacles. A severance package can be an emotional as well as a financial decision to consider. Wouldn't it be comforting to review the options for you and your family with an objective financial partner? At RIA Advisors, we're here to help. From severance pay, tax timing decisions to how to maximize unemployment benefits, the RIA team wants to make sure you can do what's best for your family. There's no charge for a consultation, so reach out to RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. I'm Real Lance Roberts, of course, and talk a little bit about this, kind of idea of no recession in 2022 and, potentially one in 2023. This is, and again, a lot of commentary out here lately, kind of the mainstream media. First two quarters were negative. That means we're in a recession, and that's not necessarily the case. It could still be classified as a recession if the possible, right? Because you do have two negative quarters, and that is kind of one of the measures of a recession in the economy. But there's other factors that play into it as well. It's not just two negative quarters. If you remember back in 2012, we had deep manufacturing, numbers, and there was a lot of concern about a recession because all of the manufacturing indexes, ISMs, et cetera, were all negative, and we didn't have a recession, because the service sector, which is now about 80% of the economy, was strong enough to keep employment and other functions working. So we avoided a recession in 2012 because of that. And again, this is kind of that same environment we have now where, we've got very weak manufacturing data, but employment's still strong and services are still doing okay and consumers are still spending. And again, as we just saw with Walmart's earnings this morning, people still shopping. Now, again, remember, though, we measure things in dollars, not in volumes. So, Walmart doesn't report we sold, 4 million units, right? They said we sold so much in dollars. That means just people are paying more for the same amount of stuff. I took my son moved to A&M over the weekend. And so, my wife and I did the obligatory, trip up to see his new place and then to take him to Target to get, his essentials that he needed. And, $500 later walking out of Target, I realized that, inflation is a thing. And, it's just that's, where we are right now. And, these are the things. So there's a lot of different, factors that feed into this. But, as we talked about before, is that, we've seen these periods historically where, we see negative growth in the economy. And while, yes, and again, we've had two negative quarters here, and again, as I said, that doesn't necessarily mean we're in a recession, but what is, because, we had two negative quarters back in 2020, and that was a recession, right? Because we shut down the economy. It was a very short recession. It lasted a total of about 3 months. And we were back out of it because of all that infusion of liquidity. So you point back and say, yeah, 2 negative quarters of GDP, had a recession, right? And then you had this massive surge of 30% of economic growth following that because of, massive influxes of capital being sent to, checks to households. So here we are again, 2 negative quarters, of GDP growth, and, not deep negative growth, but, there, and you're going, okay, well, that's a recession. But again, as we talk about these other factors, that doesn't necessarily mean, and again, it's not what it's like that old saying, I don't think that means what you think it means. It's potential here we could see a little bit different. And again, if we take a look at the ISM Composite Index, and that's a good example of what I'm talking about. So ISM, which is the Institute of Supply Manufacturing, this is the index that everybody kind of looks at as the measure of the markets. And if we take a composite of those two indexes, so it measures manufacturing and non-manufacturing. So they've got one index for the manufacturing side of the business. They've got one index for the services side of the business, the non-manufacturing. And if we just take an average of those two, we're still in expansionary territory, right? We haven't gotten down to contractionary territory in the economy. So again, that's just another reason why we're probably not in a recession right now. But importantly, it's the trend of the data that is most important, right? If you're standing at the bottom of a high rise and somebody drops a bowling ball off the high rise, right? And you're watching it fall right towards you, you're like, well, I'm not dead yet, but it just takes time for the bowling ball to reach you. And this is the same way with economic data. It's in a decline. It's clearly moving towards that recessionary territory. It's clearly telling us that there is weakness in the economy, but we're not there yet, right? The economy's not there yet, but the trend of the data is moving that direction. It's clearly telling us that economic growth is slowing here and that we've potentially got, some issues later on. And again, this is what I'm saying. Maybe the first 2 quarters of this year, even though they were negative growth, weren't really, the recession, but maybe that's still coming. And that's kind of what this data is telling us. And, and again, as I said, employment remains very strong. That's, still at historically low levels, but importantly, unemployment, right? And this is one of those big stories. Unemployment, everybody's like, the Federal Reserve's like, unemployment is still very strong. We're just printed 400,000 jobs. No sign of a recession. The problem with employment, and if you take a look at a chart of employment, what you see is that employment trends down and down and down. It's like, oh, great, we got great employment, and all of a sudden it spikes straight up. It doesn't take the stairs up, right? It's an elevator up and a staircase down. So when things change in the economy and we get into a recession, before you actually know that we're in a recession, unemployment will be spiking higher. And that is really kind of your telltale sign the recession's coming. And we don't have that yet. Again, another kind of one of those indicators that could come. And consumer confidence is clearly telling us that there is trouble in the economy. And if consumers contract, remember, businesses operate on the basis of demand. So if I've got a lot of demand in my business, then I'm going to hire more employees. If I don't have any demand in my business, I'm going to fire employees. And that's why you see unemployment spike up. You don't see it kind of just trend up, because when companies realize that demand is broken, they begin laying off and terminating employees to shelter their profitability of their business. And that's why unemployment is a very rapid rise, not a slow rise. And consumer confidence is at levels right now that are telling us that the consumer is contracting. Right? Right now, they're able to spend money because they're tapping into credit cards and they're able to make ends meet. But this is something that has a limit to the time that they can do that, and eventually, and we're seeing this now, consumers are having to make this choice between what they have to spend and what they're spending it on. And I run this chart that looks at the historical standard of living for the average family, and the gap between what it takes to fill that. And what's important about this is that if we take a look back in history, in the 60s, the 70s, the 80s, the amount of income and savings that households had was greater than the cost of living. So in other words, what the data tells you is that people had enough money to sustain their cost of living and have some money in the bank, and savings rates were high back then. We had 8% savings rates. So people were able to save money. They didn't have any credit card debt to speak of at all. Credit cards were kind of something that only really rich people had, and it was like, wow, they've got a credit card. That's pretty cool. But for the most part, everybody wrote checks. And young kids today have no idea what a checkbook looks like. But back in the day, we wrote checks or paid cash. That was the thing. Beginning in really 2009, after the financial crisis, that's where really the demarcation came to where consumers could no longer support that standard of living. And they had to, in other words, the income and the savings they had did not keep up with the cost of living. So they had to turn to credit card debt to do that. And today, and it's interesting because there was right after 2020, when we started doing all these checks, President Biden came out and said, my plan will reduce poverty in the U.S. And I wrote an article back then saying that, it'll reduce poverty by 40% for about 1 second. And which is exactly what happened, because for just a moment, because of all these checks to households, for just a moment, households were able to sustain their standard of living and have a little bit left over. But now that those checks have run out and the cost of living has surged so much, we're now back at a record level gap. It currently takes about $6,900 a year in additional credit on average just to fill the gap between the cost of living and income and savings. So in other words, my wages, my income, my savings, that is not enough to fill that standard of living. And it takes me another $6,900 in credit. And that's why we're seeing credit card debt ramp up to records right now because of that. So this all suggests that, again, that a recession is still coming. We're not there yet, but it's coming. And one of the kind of the key measures that we look at, and one of the best forward indicators of recessions, is the leading economic index. And we also run an index, in shop here called our Economic Output Composite Index, which has about 100 different components to it. It looks at, it combines the manufacturing, the services, leading indicators, global economic indicators, everything into one kind of composite index. And both of these have a very high correlation to leading recessionary outcomes in the economy. And the leading economic index, if you look at the 6-month rate of change of the leading economic index, it is one of the best leading indicators of a recession. And both our economic composite index and the 6-month rate of change of leading economic indicators, which have a very high correlation to each other because they're the same thing, are both saying that we're in a slowdown now. And if it doesn't turn pretty quickly and begin to show some signs of strength, we will be in a recession by next year. So again, a lot of indicators suggesting that the recession's still coming. And if that's the case, that means earnings will decline. Earnings will be weaker next year, and prices will have to adjust for weaker earnings growth, which suggests that maybe, just maybe, we're not back in the bull market just yet. Be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Let's be honest. Me and Brent, we're here whether it's sickness or injury.
Without fail.
Without fail. Danny gets a little sniffle and he's at home all curled up with his blankie.
Well, he's got all those Petri dishes on legs running around his house.
You know what, though? But I had that.
Yeah?
You know what happens? Your immune system gets a lot stronger.
The Real Investment Show podcast. Same show, your schedule.
Drink out of the garden hose.
At realinvestmentadvice.com.
That was the best water.
It was. It's not great for you, but...
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Have market gyrations caused you to lose sleep? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. If you think it's time to work with an advisor who puts your interests first, it's time for Real Investment Advice. RIAadvisors.com.
You're listening to The Real Investment Show.
Welcome back to the show this morning. Interesting article in the U.S. Sun today. Ice cream and beer lovers can now enjoy the two treats at the same time after Miller High Life rolls out a unique offering. The classic beer brand is announcing its new dive bars on Monday, and they are full of surprising flavors. In the wake of the ice cream trends that have reached brand new heights, such as ketchup, ice pops from French's, and Grey Poupon, the frozen dessert, just doesn't make you want to just run out and buy them, does it?
No.
Miller High Life has turned up with adult ice cream brand Tipsy Scoop, and the partnership aims to create the best alcohol-infused ice cream from the champagne of beers. Food and Wine. This is written by Food and Wine. So they infused beer into the dairy dessert. It has 3% alcohol. So basically, if you eat enough ice cream, you can get drunk and fat at the same time, which kind of the same thing happens with beer. Anyway, some of the flavor implementations are symbolic, like the inclusion of a smoky tobacco flavor and the caramel added to represent the feeling of a sticky dive bar floor. Sounds appetizing. Others are literal, like the inclusion of peanuts to remind the palate of the essential dive bar snack, and carbonated candies are shuffled into the mix intended to mimic the fizziness that beer lovers crave. Of course, you can't get CO2 right now because that's damaging the planet. The smooth dark chocolate finish is meant to evoke the familiar wood and intimate lighting of many dive bar shares. Again, none of this is just really making me want to run out and buy the ice cream.
It's not cheap either.
No, it's not cheap. It's $6.95 a bar.
Yeah.
Pretty pricey. But again, the Klondike Choco Taco is been discontinued.
Did you ever have one of those?
No.
I didn't either, and I kind of felt like I missed out.
Apparently, because they're selling for $795 on eBay.
Really?
Man, people will buy anything after it's discontinued.
That's true.
I've never had a Choco Taco, but damn, I want one now that I can't get it. Speaking of can't get it anymore, because of climate change, the iconic manufacturer of the Dodge Challengers and Chargers, which have made a real resurgence here over the last few years. Really, since about 2006, they were kind of relaunched under the Dodge brand, and they had the Dodge Challengers and the Chargers, and of course from that they made some real ground pounders, the Hellcat and Scat Packs and others. And the Hellcat has like 700 horsepower and big block engine and just does stupid things you shouldn't do in a car on a street. But nonetheless, I mean, these cars have sold really, really well and put really kind of Dodge back on the map. But that ends next year. They will no longer be manufacturing the Challengers and the Chargers because of climate change. And this is exactly what they were talking about. I'll just read you a clip from this article. It's on CNBC this morning. Dodge has been able to juice profits from the vehicles, which have started pricing ranges from the low 30s to nearly $90,000 for its infamous Hellcat models. Again, that's the one with 700 horsepower to it. The Dodge with the Challenger and Charger, they really found a way to get to that muscle car route. And again, look, a lot of these people, hunt for these 1971 Chargers that they do, full remakes on and then sell them at Barrett auction for like $150,000. The cars definitely express that. We're able to hold on to the essence of that. Having that clear DNA and clear expression of what they were supposed to be is helping make that transition. What's that transition? It's the transition to electric. Dodge CEO Tim Kuniskis has alluded to the possibility that the Charger and Challenger names could be used for future electrified vehicles, including the forthcoming electric muscle car in 2024. He previously said he believes electrification, whether it's hybrid with less powerful engines or all electric models, will save what he has now called the golden age of muscle cars. I'm not sure about that. Again, muscle car enthusiasts have this real knack for wanting to, build big block engines that are loud and noisy and
powerful.
Well, look, electric engines are powerful.
Oh yeah.
There's this interesting show that my wife and I watch on Netflix called Rust to Riches, and this garage out in California, it's Gotham Garages. He found a Prius, and he's like. And he wants to do his Gotham Garage makeover to this Prius and then sell it. And, everybody's like, a Prius? And he's like, you have no idea. This is a hot rod under a hood. And these cars are really a lot faster than what people think. So he's doing this whole makeover on a Prius, which is pretty funny, putting skirts on it and all kinds of stuff. But, it's just, even though Toyota didn't do a great job of, building the body of it to make it look attractive. If they would have put a sports car body on the Prius, it probably would have sold a whole lot better than making it look like a rolling lemon. But
Dodge has the branding in place, though, for the electric vehicle, the Charger. I mean, that would make perfect sense.
Yeah, it would.
But have you seen what Ford did to the Mustang?
I know. That's the problem is they start altering the design, the body design. If you leave the body design alone, right?
Keep it looking like a Mustang.
Yeah. The days of the Iron Block, so Kuniskis goes on to say, the days of the Iron Block supercharged 6.2-liter V8 are numbered, unless you ask a motor enthusiast. which I doubt that they will agree with you. But he says, referring to like those in the Hellcat, he says, but the performance that these vehicles generate is not numbered. So it's going to be interesting. These car companies are going all in on electric. So Ford's doing it, in a big way, as Brent just mentioned, the all electric e-tron, which that's Audi, the all electric Mustang. Audi has the e-tron. The new Ford Lightning pickup truck, which is off the 150. So again, all these companies are making a transition. And in fact, another kind of sideline of this is that Detroit, which is where, all these cars used to be manufactured, they're all moving south to manufacture them cheaper because of the cost of building an electric car. And again, you've got to get these price points down to where, people can afford them. Again, right now is with like the problem with the Tesla is that they're so expensive that only kind of the upper income earners can buy an EV. So if you want to have, all electric vehicles, across the country, and you want to move in that direction, then of course you've got to get these price points down to levels where people can afford them. And this is why used cars continue to sell in such strong numbers, because people on the lower income basis, which by the way is a big chunk of the population, they can't afford these higher priced vehicles. So they're shopping used cars that they can buy for $10,000, $15,000, $20,000. And that's where they have to live. And they have to finance those at really cheap rates in order just to afford the monthly payments. Again, as we've always talked about before, it's not an issue of the price of the car, it's the price of the payment. And when interest rates go up, the price of those payments go up and people can't afford the monthly payment. So it doesn't matter what you charge for the car. If I can get it cheap enough on the term of a monthly payment, people will buy it. And this is why we see a lot of this, if you've ever wondered or thought about why you always see these car companies come out and they're like, oh, dealer incentives and 0% financing for qualified buyers and blah, blah, blah. Got to get that payment down to get those cars moved off the lot. And, so interest rates matter a lot. And with the Fed hiking interest rates, those interest rates on financing, particularly shorter duration financing terms, 3 years, 5 years, 7 years, which is normally kind of your car loans, those rates get impacted pretty quick. Those rates go up because it's shorter term financing and they're banked off against shorter term bills. So, this is going to be a challenge. And then not to mention, the problem with just being able to provide all the power to charge electric vehicles. So as you start making this transition into more and more electric vehicles, you're going to have battery supply problems, components for batteries to meet them. Of course, you've got problems with, the power grid being able to handle the additional drag of consumption of energy. And it's interesting, we talk about, out in California, they got rolling blackouts and they, ask people, hey, turn up your AC, turn down your, turn off your lights, conserve energy. Because, we don't have enough of it. Well, it's going to get worse the more that you have people charging vehicles, on the system. Not to mention having to build out superchargers and all these other things that we've got to do. So again, the real viability, it's interesting to watch the, automakers kind of jump off the cliff here with EVs and all trying to chase Tesla at this point. That's all this is right now. Everybody's looking at Tesla going, well, Tesla's doing a pretty good job here. And people are buying the product, maybe we better get there. So everybody's kind of jumping off that ledge, but nobody's really kind of looking down the road as to saying, yeah, but once this happens, what's going to happen? What's the unintended consequence that nobody's looking at? And once you get to the part to where charging your electric vehicle is so freaking expensive, people will start to make that shift back towards gasoline. That's if you remember a while back, when gas prices, previously back in 2008, 2009, when oil prices were spiking up and it was, the kind of the end of the planet and the end of oil as we knew it, everybody was saying, we got to get rid of SUVs. And everybody was chunking their SUVs. We had people riding their bikes to work and all kinds of stuff because they couldn't afford to fill up their SUVs. And as soon as gas prices went down, guess what happened to SUV sales? Right back up. So, at the end of the day, consumer drives the boat. We'll see what happens. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning, 6:47. Get ready to wrap up the show for the day, get you off to work. Of course, is never fun, but something we got to do. You know, one thing, make sure and go by the website, realinvestmentadvice.com. Our latest report is out on the website talking about no recession now, but one probably in 2023. Of course, lots of debate on that, right? You know, can the Fed, keep hiking rates to combat inflation and not cause a recession? And, there's arguments for that. Goldman Sachs out this morning saying that there is a potential that, the Federal Reserve can do that. And they can kind of navigate this, this kind of, environment to where they can, combat inflation, but we still get growth out of the economy. It hasn't happened before, right? We go back to the, 60s and 70s, and, there's clear evidence that when the Fed was trying to hike rates back then, that the economy did not fare well. In fact, more often than not, we kind of wound up in a recession or bear market or something because of the impact of higher rates on the economy and the costs that go along with higher rates. I mean, it's just kind of, common sense, but there's always hope, right? There's always hope the Fed can do this, and they just unfortunately never quite can do it. But there's always hope. And pretty much like 2009, we were in the middle of 2008, in the middle of the, people were coming out saying, it's a soft landing scenario. Ben Bernanke, economy's going to be in a soft landing. We got this. Don't worry about it. Of course, it wasn't a soft landing at all. It was more like a head-on crash. So, that's where it is. But, and we're trying to do things to, help promote things and do other stuff. And of course, President Biden's expected to sign, this week, the historic landmark bill of $700 billion that will supposedly lower the deficit and reduce inflation, right? It's the Inflation Reduction Act is the name of this. And that's a bold statement, but it will appear to reduce inflation. The bill actually won't reduce inflation. It'll actually cause inflation, but simply because of the rate of change of growth in the inflation, how we measure it, it will appear as if the bill reduced inflation, right? If you did nothing, right, inflation would go down. And we're already starting to see peak inflation now behind us. And, that'll be a consequence of the math as we begin to compare year-over-year numbers. So if I add $700 billion to the economy over the course of the next 10 years, it's about $70 billion a year, it will actually add to inflation. But the rate of disinflation will be greater than what they're adding, so it'll still appear as if the Inflation Reduction Act is reducing inflation. From a marketing standpoint, whatever economist told them to do this was brilliant because, it's almost a surefire win, especially with the Fed hiking rates. Doesn't mean you'll necessarily like the outcome. Experts are, of course, they're mixed on the benefits of this, and there's some potential benefits, obviously, to the supply side of the economy. But in the longer term, inflation should be under the control of the Fed, and we'll see how well they can control it because historically their track record has not been great at that, as I said. But as JP Morgan said yesterday, over the horizon where the things are visible in the next year or two, we don't see big effects on either growth or inflation for that matter relative to this bill. And where's inflation right now? It's in gasoline, airfare, household energy, transportation, those type of things. The big chunk of inflation right now is coming from gasoline, and that's why we saw in the latest inflation report that reduction in gas prices offset the increases in everything else. Food prices went up, everything else went up, but gasoline prices came down. So it looked as if we actually had a lower rate we had zero inflation, for the month of July. But, again, how long gas prices will stay down is another question. If we get another spike in gasoline prices, well, inflation is going to come back. Experts are mixed on the macroeconomic effects of the Inflation Reduction Act. The Tax Foundation forecast a negative 0.2% long-run GDP and a loss of 29,000 full-time equivalent jobs. Revenue raisers, including in the bill, are also expected to take substantial time to kick in, meaning a wider budget deficit and worsening inflation. That's according to the Tax Foundation. So, again, this is, kind of the other thing, and it's interesting, so part of this bill, we talked about, hiring 87,000 IRS agents. Of course, that's going to be more tax audits for middle-class Americans, extracting more capital and time. When you're going through an audit, you have to spend money, right? You've got to hire an attorney or an accountant to help you, deal with the audit. Or if not, if you're going to do it yourself, that's fine. Generally not a good idea. But, if you're going to fight it yourself, that's fine. But it's still your time that you're going to be involved in dealing with this audit, which means less productivity for, households. So again, as you start to see an increase in audits on middle-income Americans, that's going to extract more tax revenue from middle-income Americans, which don't really have it right now anyway. There's going to be, a lot of pushback on this. Now, one thing about this bill, by the way, is that just because Biden passes this bill now doesn't mean it's cemented in forever. And, whoever takes office after the midterms, as an example, or, after the next election in 2024, can come back and defund the IRS, as an example, remove, tax credits. So, bills only live their life from one kind of administration to the next. Now, it may be that this bill, survives longer term. Some bills do. But again, it wouldn't be surprising that if the conservative Republicans take control of the White House, Senate, and Congress in 2024, that one of the first things they come in to do is to unwind this bill. That wouldn't be surprising at all. So again, why we're talking about this now, and we're talking about $700 billion spent over the next 10 years, so $70 billion a year into an economy of $20 trillion. It's a very small, negligible impact to start with, but while we're talking about it now, doesn't mean it will survive the full 10 years. So, it's also something we just have to remember about the way that kind of Washington works. But it is interesting because as you talk about this, the Inflation Reduction Act imposes a 15% corporate minimum tax rate. Well, that means that, if corporations like Amazon have to pay a 15% minimum income tax, that's okay. They're just going to pass that cost on to you. So the prices of memberships are going to go up. The prices of subscriptions will go up. The prices of goods or services that you use are going to go up because those taxes and those extra costs get passed on to consumers. So again, it's always those knockoff effects of these bills and things that we pass. It's like, oh, this is a great idea. We're going to raise more revenue. And we're only going to get it from this group of people, right? We're only going to get it from those billion-dollar-plus revenue corporations. Okay, sounds great. It gets passed down to everybody else. And it gets passed down to the suppliers. It gets passed down to the consumers. It gets passed down to the manufacturers. Everybody's going to get hit. So, these things never operate in isolation. The Joint Committee on Taxation estimates that only 150 taxpayers would be targeted and projects a 1.4% average increase in federal taxes for all income taxes. So, all income tax brackets. So in other words, even though we're going to only target 150 corporations that make over $1 billion in revenue, that target is going, according to the Joint Committee on Taxation, is going to increase the average federal tax for all income brackets by 1.4%. Now, that doesn't sound like a lot, but for Americans who are already living literally paycheck to paycheck, an additional 1.4% is a monthly payment for something. Right, so it's something, it's buying groceries, it's something, right? Even if it's $50 a year, that's something to come to households that are literally living paycheck to paycheck every single year. So it does make a difference, even though it doesn't sound like a lot. So again, look, we're going to get through all of this ultimately. We're going to get through, the slowdown in the economy. We're going to get back to growth eventually. We're going to get, inflation's going to come down, and we're going to look back on all this in hindsight and say, yeah, remember when we were dealing with this? Whew, glad that's over. We're going to get there, right? The question is when do we get there, and how long does it take to get there? And will, spending more money in the economy, going further into debt, help that situation? Or will it prolong it? And these are the things, and again, we won't know for sure until we actually see the implementation of this and how it actually works and how it actually impacts the economy. But these are things we want to be paying attention to, because again, over the next year in particular, and again, going back to our article on our website today, talking about no recession now, but coming in 2023, these are the things that we're talking about. How does all this impact the consumer, which is roughly 70% of the economy? And then the rest of the economy is imports and exports and capital spending and government hiring and these type of things. How does consumption of that bottom 70% affect that other 30% of the economy that's driven by their demand, right? Because again, we're a demand-driven economy. It's consumption and what we do that drives the economy. It's us buying cars and houses and boats and planes and all these other things that drives the economy. And so what we're going to be looking at 2 years from now is looking back at all of this and the things that we're talking about now going, yep, see, that's how that turned out. Let's not do that again. Or let's do more of that because that worked really well. Generally, it's the former. All right, wraps up the show for the day. Be back tomorrow, of course, for Wednesday. Danny Ratliff will join me. We'll talk a little bit on the financial side of the economy, personal finance side of the economy and your money. That's tomorrow, of course, for the Wednesday edition. Get by the website. Again, that latest article is up. Also, our daily commentary is out, so make sure you're subscribed. Get our daily market commentary. Tells you what you need to know for today on what's going on in the markets and your money. It comes out every morning. We send it to you by email, so if you subscribe today, you'll get it this morning by 7:30. Write your email inbox, and you'll get it every day, Monday through Friday. Keep you up to date on the markets. All right, we'll see you tomorrow. Have a great day. RealInvestmentAdvice.com.
It's a rich man's world. It's a rich man's world.